Hello there, and welcome to lesson 1. In today's lesson, what we want to do is dive into the 3 types of money, some examples of each of those types, and the ideal amount that you should hold in each of those type of accounts. Those 3 type of accounts are taxable, tax deferred, and tax free, or what you'll also see referred to as tax exempt. Now there's a mathematically ideal amount to have in each type in order to maximize your retirement income in a rising tax rate environment. If you recall, back in section 1, we talked a lot about the chances of increasing tax rates and the importance of protecting your retirement finances from that inevitability in the future. So in this lesson, we're going to dive into the taxable, tax deferred, and tax free types of accounts. Now this first one, taxable, is any type of account that you're taxed on any growth in that given year. For example, you can see on the slide a savings account at your bank or credit union, a money market account, or any of your brokerage accounts. So stocks or bonds that you hold in your brokerage accounts, or any interest that is earned on those assets is taxed in that tax year. Now the ideal amount to hold is 6 months worth of lifestyle expenses. Why would that be the case, Devin? Well, if you think about it, if the majority of your assets are held in a taxable account where you're taxed every single year, you can see how that might bump up your tax bracket over time, especially if it's a large amount. The second type of account is a tax deferred account. These type of accounts you might be very familiar with. These are 401k accounts, 403b accounts, 457, IRA, SEP IRA, essentially any type of retirement savings asset that has not been taxed yet. All of your contributions into your plan, all of your employer's contributions into your plan, and any of the growth over the last 40 years of your working years has not been taxed yet. So what is the ideal amount to hold? Well, enough for a standard deduction or itemized deduction, or like we'll learn later in class, a qualified charitable distribution to cancel out any taxable distributions. Essentially into your retirement years, we want to be careful to make sure that these balances or the required distributions don't torpedo your retirement finances. The third type of account is a tax-free or tax-exempt account. A Roth IRA, Roth 401k, any Roth conversions, or also any cash value life insurance policies or health savings account balances. All of these type of accounts grow tax-free. Now the ideal amount to hold is as much as possible because distributions are tax-exempt. Last week, at the end of section 1, you were asked to take the time to fill out your retirement financial profile worksheet, which included listing out the values of all of your accounts. If you look at that worksheet, you will see that these accounts were organized into taxable, tax deferred, and tax exempt groups. Understanding these 3 types of accounts and their fundamental tax characteristics will help you understand and rewrite your tax story, which is the primary focus or goal of this masterclass. Now that we have properly characterized all of the financial accounts, let's move on to lesson 2 and further explain the difference between an IRA and a Roth IRA. I'll see you in lesson 2.